Next up, housing. And this is an area where I will tell you for a lot of clients that we're talking to who had intentions on selling a home or buying a home, if it's something that was just a want to purchase, and they can technically stay where they are, we're kind of telling people to stay where they are. But if you're in a situation where you just have to buy a home, then there are some things that you can consider. One of those would be what's called rate buy downs. So a rate buy down is essentially when you either are offered by the lender or in some cases the builder to give extra money at the time that that house is being built or give extra money at closing to buy down your interest rate. And the easiest, and I would say the most consistent way that I've seen to buy down a rate, and this can change based on the lender, can change based on the builder, is you do it based on points. And a point is 1% of the loan amount. So for example, with a $500,000 loan, 1 point would equal $5,000, 1% of the loan amount. And oftentimes what you'll see is that paying 1 point reduces your mortgage by about a quarter of a percentage. So if you have a $500,000 loan at 6.5%, you can pay $5,000 to buy down that rate to 6.25%. And to be in this position where a rate buy down makes sense in your position to actually do it, you have to have assets on hand, which we'll touch on later in the podcast. So not everybody can do it, but if you can do it, it is one way that over the course of time, if you have the money up front, you can lower the long-term costs of owning that home. Because for example, if you can afford 2 points and buy it down 0.5%, while it seems like that's not that big of a deal, over the course of a 30-year mortgage, that could save you significant funds, both in terms of the monthly payment and the interest that it takes to pay off that loan in full. As an example, if you're looking online, you're looking at a mortgage payoff calculator, and we're looking at a $500,000 mortgage for a 30-year loan at 6.5%. If you go to the amortization table, you can see that the cost of this on a monthly basis would be about $3,200 a month before you add things like homeowners insurance and property taxes and the like. And over the course of 30 years, it would take you $1,137,722 to pay off that loan that was initially a $500,000 loan. Now, let's assume that somebody pays 2 points to buy down their rate 0.5%. So they pay $10,000 to pay down their loan to 6% from the original 6.5. Well, you can see that instead of $3,200, it lowers their payment by about $200 a month. But in terms of the total repayment, they save almost $60,000 over the course of 30 years because of the $10,000 they paid on the front end of the process. So it's a balancing act because money that you have now is typically more valuable than money that you have in the future. But if you have the reserves to buy down a rate, it's something that could lower your total cost of ownership and lower your monthly payments in the face of potentially increased home prices. Another thing I would want you to consider before you even enter into this process, and based on the type of home for which you're looking, is to actually consider how long you'll be in the next home. We've talked about this in previous episodes. I am not a big fan of people going through the process of buying marginally better homes than the one that they're currently in. And the reason I'm not is because when you buy a home the first time, it often doesn't cost you anywhere near as much as it will in subsequent purchases. You're likely using a first-time home buyer program where you're putting 3.5% down on that home as compared to the 10 to 20% that will be needed in subsequent purchases. And when it costs you more to buy your next home, there's typically two ways that you're going to finance those additional funds. Either you are hoping that the home significantly increases in value from the time that you purchased it. You're going to use a portion of those proceeds or all of those proceeds to pay the down payment, or you now have to have the additional funds to make up that difference. And the difference between 3.5% down on a $500,000 home versus 10 or 20% down is significant. So if your home doesn't increase in value significantly, you are putting a strain on your ability to actually go get a home that's a substantive improvement. And while in certain markets, that was a near guarantee that your home would increase in value significantly the past few years, even in the quote unquote booming markets like a Nashville, like a Tampa, like a Miami, like an Atlanta, over the past 3 or 4 years, you're starting to see homes that are either not increasing in value at all, some are decreasing in value, but definitely not a big enough jump where you can just assume that I can buy this home and within 3 to 5 years, I'm going to get enough from the sale to go get an even better home. So if you're in a home search and you don't think that you can significantly upgrade, then I would consider staying put if you're able to. But if you are in a position where you have to buy, even if it means potentially paying a little bit more and doing things like rate buy downs to make sure that the long-term costs are mitigated, I would make sure that you are truly getting a home that is both an upgrade as to where you are currently, but in a worst case, a place that you can stay for a significant period of time so that if it doesn't increase in value, or you're not in a position where the environment is stronger to buy your next home, that you don't feel like you're in a place where you can't stay long term.